Hey everyone, welcome back to Magic Market, where we break down the biggest stock market trends, financial updates, and analysis to keep you ahead of the curve. Today we're diving into a crucial topic for investors in Disney's debt. You've probably heard that Disney is one of the largest and most influential entertainment companies in the world. But did you know it carries tens of billions of dollars in debt? In this video, we're going to take a deep dive into Disney's financial obligations and break down exactly what investors should know. How did Disney accumulate so much debt? Is this a potential risk for investors, or could it be part of a larger strategy? Let's break it down and find out. Let's start by examining just how much debt Disney is carrying. As of late 2023, Disney's total debt stands at a staggering $42 billion. That's not an insignificant amount, but in the context of Disney's vast revenue streams, it's not necessarily catastrophic either. To give you a better sense of the financial picture, let's break down Disney's debt a little more specifically. Total debt, approximately $42 billion. Long-term debt. A significant portion of this debt isn't due for over the next 10+ years, which gives Disney ample time to manage and reduce its obligations. Debt-to-equity ratio, currently around 0.4, which means Disney's debt load is relatively moderate compared to its equity and assets. This indicates that the company isn't excessively leveraged like some companies in other sectors. Although $42 billion might sound daunting at first glance, it's important to consider the context. Disney generates billions in revenue each year, and its assets like theme parks and intellectual property hold substantial value. So while this debt load is large, it's not necessarily unmanageable. However, to truly understand the gravity of Disney's debt, we need to take a closer look at where it came from. Disney wasn't always carrying such a heavy debt load, but several key decisions in the past few years have contributed to its current financial position. Let's go through the major factors that contributed to Disney's rising debt. The Fox acquisition, a $71 billion deal. In 2019, Disney made a historic move by acquiring 21st Century Fox for a whopping $71 billion. This acquisition allowed Disney to gain control over Fox's extensive film and TV assets, including iconic franchises like X-Men, Avatar, The Simpsons, and many others. This purchase undoubtedly helped solidify Disney's position as a dominant player in the entertainment industry, but it also required taking on significant debt. The deal was structured to include both cash and debt, and although it has proven valuable in terms of content and IP acquisition, the financial pressure from the debt remains a key consideration for investors. This move was strategic, but it's important to note that such large acquisitions often come with long-term financial consequences. Disney's acquisition of Fox has undoubtedly expanded its portfolio, but it also added billions in liabilities to its balance sheet. Disney Plus and streaming expansion. Disney's aggressive push into the streaming market with Disney Plus, Hulu, and ESPN Plus required massive investments. Disney's streaming division has yet to reach profitability, and much of the company's debt has been used to fund content creation, global expansion, and technology. Disney Plus is poised to compete with giants like Netflix, but the financial losses incurred while scaling up its operations have further contributed to the growing debt load. The company has poured billions into content creation and technology infrastructure in an effort to create a compelling product that can rival industry leaders like Netflix and Amazon Prime Video. However, this expansion strategy has been costly, and Disney's streaming division is still in the red. Despite the potential of Disney Plus, the company has yet to turn the streaming platform into a profitable business, and the mounting debt reflects the challenges it's facing in this sector. COVID-19 shutdowns and recovery. The COVID-19 pandemic was another major factor in Disney's debt accumulation. The pandemic forced the closure of Disney's theme parks, cruise lines, and movie theaters for extended periods, resulting in billions of dollars in lost revenue. To maintain liquidity and continue operating during these difficult times, Disney borrowed extensively to bridge the gap. Although the company has recovered in many areas, The debt remains on its books as a reminder of the financial challenges faced during the pandemic. This period of recovery required borrowing at an accelerated pace to maintain operations and keep employees paid while the company's key revenue sources were largely inactive. While Disney has bounced back, especially with its parks and some of its movie releases, the debt accumulated during the shutdowns continues to weigh on its financial statements. Let's take a look at how Disney is handling this debt, though. So, how is Disney managing its substantial debt load? Well, the company is taking a number of steps to address its financial obligations, and it's important to recognize that Disney's current debt position doesn't necessarily spell disaster. Let's break down the key ways that Disney is managing its debt, paying down debt gradually. Disney has made it clear that reducing its debt is a priority. In 2023 alone, Disney paid off approximately $6 billion in debt. This effort was mainly funded through strong cash flow generated by the company's theme park operations and growing revenue from its streaming services. By slowly paying down its debt, Disney is reducing its interest burden and strengthening its financial position. While $6 billion in debt reduction is a positive sign, it's important to note that this gradual reduction may take years to substantially lower the overall debt, especially considering the total amount involved. However, Disney's ability to pay down this significant amount of debt in 1 year shows that it has the cash flow to tackle its liabilities, and it gives investors a degree of confidence moving forward. Strong cash flow from theme parks. One of Disney's most reliable revenue streams comes from its theme parks and resorts. These businesses are highly profitable and provide a steady cash flow that helps support Disney's overall financial health. In fact, Disney's Parks and Resorts division contributes billions annually, helping the company cover interest payments and reduce overall debt. This makes Disney's debt more manageable compared to other companies that lack such profitable divisions. Disney's parks are among the most popular worldwide, attracting millions of visitors each year and generating billions of dollars in revenue. This stable cash flow is a key asset in helping Disney manage its debt burden and continue to reinvest in its other businesses. Cost-cutting and efficiency. In addition to paying down debt, Disney has been implementing cost-cutting measures to improve its profitability. Under CEO Bob Iger's leadership, Disney has made several strategic moves to optimize operations, including reducing content spending, cutting jobs, and streamlining corporate processes. These efforts are helping to boost margins and reduce financial strain, although some of these decisions have faced scrutiny from various stakeholders. The company has also been re-evaluating its portfolio of assets, divesting non-core operations, and focusing on its strongest businesses. These moves are helping Disney maintain a solid bottom line while also providing the resources needed to continue paying down debt. While Disney is actively working to manage its debt, investors should be aware of certain risks that could impact the company's ability to maintain its current financial position. Let's take a closer look at some of the potential risks associated with Disney's substantial debt. One of the key risks to Disney's debt management is the possibility of rising interest rates. As interest rates increase, the cost of borrowing rises, which could make it more expensive for Disney to refinance its debt in the future. Since Disney has a significant amount of long-term debt, any increase in interest rates would translate to higher interest payments, which could reduce profitability and limit the company's ability to reinvest in its business. If Disney needs to borrow more to finance expansion or cover operational costs, rising interest rates could eat into its cash flow and make it more difficult to reduce debt. For example, if interest rates rise sharply, Disney might need to divert funds away from strategic investments like content creation, theme park expansions, or streaming services to cover the increased debt payments. This could delay the company's plans for growth and put added pressure on its finances. Investors should keep an eye on the Federal Reserve's interest rate policies and any signs that rates might rise in the coming years, as this could have a significant impact on Disney's financial health. Another major risk facing Disney is the potential for slower than expected growth in its streaming division. While Disney Plus has seen impressive subscriber numbers since its launch, it has not yet reached profitability. The streaming business is capital intensive, requiring constant investment in content, marketing, and technology to compete with rivals like Netflix, Amazon Prime Video, and Apple TV+. Disney has been betting big on streaming as the future of entertainment, but there's no guarantee that Disney Plus will achieve profitability in the timeline the company has set. If Disney is unable to achieve profitability in its streaming division, especially as competition intensifies, it could become much more difficult to pay down its debt. The streaming market is still in its infancy, and Disney is facing the challenge of balancing subscriber growth with profitability. If Disney's streaming services continue to lose money or fail to gain market share, it could drag down the company's overall financial performance. Investors need to monitor the company's progress in this area closely and be prepared for the possibility that Disney's streaming segment might take longer than expected to become a reliable revenue generator. Economic downturns present another risk to Disney's financial position. During recessions or periods of economic uncertainty, consumer spending tends to decrease, which could negatively affect Disney's revenue streams. For instance, fewer people may visit Disney's theme parks, cruise lines, or make new purchases at retail stores. Likewise, if families tighten their budgets, they may cancel streaming subscriptions or be less likely to subscribe to Disney Plus. These declines in consumer spending could make it harder for Disney to meet its debt obligations, especially if the company is relying on growth in its core businesses to cover debt payments. In a recession, Disney could face reduced demand for its entertainment products, which could hurt both its theme parks and its media divisions. Additionally, lower consumer confidence may lead to slower growth in Disney's core businesses, impacting revenue and making it more difficult to manage the debt load. Investors should be prepared for the possibility of lower than expected growth in the event of an economic downturn, and they should closely watch economic indicators to gauge the likelihood of a slowdown in the broader economy. Despite the risks, Disney's debt also presents several opportunities that could ultimately lead to long-term growth and success for the company. By strategically leveraging its debt, Disney has the chance to create new revenue streams, drive expansion, and reduce financial strain over time. Let's take a look at some of the key opportunities that could turn Disney's debt into a competitive advantage. One of the most exciting opportunities for Disney lies in its theme park business. Disney has committed to investing a massive $60 billion in expanding its theme park operations over the next decade. This includes new attractions, hotels, and even new parks in international markets. If successful, these investments could generate substantial new revenue streams for Disney, helping to cover debt obligations and strengthen its financial position. Theme parks are among the most profitable aspects of Disney's business, and expanding these operations could significantly increase the company's cash flow. New attractions, expansions, and innovative experiences could help draw more visitors to Disney's parks, even in the face of increasing competition. Additionally, international expansion into emerging markets could open up new revenue opportunities for the company. As Disney continues to leverage its iconic IP, like Star Wars, Marvel, and Frozen, it has the potential to attract a global audience, generating billions in ticket sales, merchandise, and hotel revenue. The success of Disney's theme park investments could also have a significant impact on reducing the company's debt. With billions of dollars in revenue from its parks and resorts, Disney could accelerate its debt repayment while continuing to invest in other high-growth areas of the business. Disney has set ambitious goals for its streaming division, particularly with Disney Plus. The company plans to make Disney Plus profitable by 2025, which could have a transformative effect on its financial health. If Disney can successfully turn its streaming platform into a profitable business, it would provide the company with a significant new source of revenue that could be used to reduce debt and fund future growth. Increased profitability in streaming would allow Disney to reinvest those profits back into content creation, technology, and further global expansion. By achieving scale in the streaming market, Disney could potentially rival Netflix and other industry giants, cementing its position as a dominant player in the digital entertainment space. The ability to achieve profitability would also help alleviate some of the financial pressures that come with the company's debt load. Investors should watch for updates on Disney's streaming performance, as this could be a key factor in the company's financial recovery. One of Disney's greatest assets is its vast portfolio of intellectual property, IP. Disney owns some of the most beloved and iconic franchises in the world, including Marvel, Star Wars, Pixar, and ESPN. These IPs provide Disney with numerous opportunities to monetize content across a variety of platforms, from theme parks and merchandise to movies, TV shows, and even video games. Disney's ability to leverage its IP portfolio gives the company endless ways to generate revenue and reduce its debt. By creating new content, merchandise, and experiences centered around its most popular franchises, Disney has a unique opportunity to drive consistent revenue streams. For example, the Marvel Cinematic Universe, MCU, continues to dominate the box office, and Star Wars remains one of the most popular franchises globally. Disney also has exclusive streaming rights to these franchises, which positions the company well for both short-term revenue generation and long-term growth. Investors should take note of how Disney continues to capitalize on its IP portfolio. If Disney can continue to produce hit films and television series, along with leveraging its franchises in other profitable ways, it could further strengthen its financial position and pay down its debt more quickly. So, should investors be concerned about Disney's debt? The short answer is, not necessarily. Let's summarize what we've learned. Disney's debt is large but manageable. While $42 billion is a significant amount of debt, Disney has the cash flow and assets to manage this burden. The company's revenue from theme parks and streaming is helping to cover debt payments, and it's actively working on reducing its liabilities. Disney has been reducing its debt slowly but steadily. In 2023, the company paid off $6 billion of its debt, a positive sign for investors. While this process may take time, it demonstrates that Disney is making progress in its efforts to become more financially stable. The company's ongoing investments in its theme park business, along with its ambitions to turn streaming profitable, could be key to reducing debt in the future. Disney is positioning itself for growth in both areas, and if these initiatives succeed, they could significantly improve the company's financial standing. That said, investors should keep an eye on rising interest rates, the performance of Disney's streaming division, and potential economic downturns. These factors could influence how well Disney manages its debt moving forward. However, given Disney's strong brand, cash flow from theme parks, and strategic investments, it's clear that the company has the resources to weather these challenges. Bottom line, while Disney's debt is something to monitor, the company's financial strength and expansive brand portfolio mean it has plenty of opportunities to turn its debt into long-term growth. Investors should be cautiously optimistic, but always be ready to adjust their strategies if market conditions shift. That's it for today's deep dive. What do you think about Disney's debt? Is it a red flag or just part of doing business? Let us know your thoughts in the comments below, and don't forget to like, subscribe, and turn on notifications so you never miss a financial update from Magic Market. Thanks for watching, and we'll see you in the next video.